Hi, everyone. Thanks for tuning in today. My name is Ida Rademacher. I'm the co-executive director of the Financial Security Program at the Aspen Institute and a vice president here, looking at across the board at a lot of issues that help create a more inclusive and robust economy in the United States. We're really happy to be once again kicking off with the Future of Wealth discussion series. Today, specifically with a conversation about the role of the retirement saving system and retirement policy in general, its role in building wealth and financial security, its role as part of a national policy and market innovation issue that is a consequential both for the macroeconomy, but also obviously at the household level in every single way. I think it's been telling if you've been watching the news in recent months, there's been a flurry of activity on issues of retirement savings and the retirement system. And we're delighted today to be really doing our part to do what we've said for a long time we're trying to do here at the Aspen Institute, which is really have the solutions-focused conversations that are necessary to create both an inclusive and a robust level of financial security and dignity for households in America. For those who haven't looked at our past Future of Wealth discussion series episodes, please go back. They'll all be linked. We've had them on a number of different aspects of the different asset classes and asset building opportunities that build wealth for households. But when you take it from the top of the balance sheet down, you'll see that for most households in America, the only places, really for the bottom 60–70% of the population in America by income, the places where wealth has accumulated historically has only been in home equity, and to the degree that they have financial assets, they have been in the retirement savings system. So that is both a system of incredible productivity in terms of how it's helped the United States create some of the deepest and strongest capital markets in the world. But the other side of that is that the retirement saving system, that private system, is only working for about half of Americans. And it's meant to work in conjunction with the Social Security system and with additional kinds of personal assets to really think about what does it mean to have retirement security in the end of your life. And that end of life longevity time horizon is getting longer and longer. We've got some critical checkpoints to deal with in the retirement saving system to make it work over the long run for more people. And today we're going to kick off with a conversation that I get to have the privilege of having with two of the CEOs of two of the most consequential financial services firms that work on different aspects of the private sector retirement savings system. So if I can ask Ed Murphy, who is the president and CEO of Empower, to turn on his camera, and Yi-Hsin Hung, who's the president and CEO of State Street Global Advisors. Sorry, I tripped on that. Good morning to both of you, or good afternoon, depending on where you are.
Good afternoon, Ida.
Nice to see you.
Thanks so much. I was doing a little bit of the background work, and while in the retirement savings system, the private system, mainly in the defined contribution space, you all serve very different functions with your companies. You really touch millions and millions of Americans. I think, Ed, Empower's got over 18 million Americans in saving for retirement on your platforms. Collectively, over $5 trillion worth of assets being managed and taken care of on your platforms. And so a huge part of that capital markets conversation that I alluded to is one that you all are stewarding and think a lot about. And I also want to start with being on the record that you also think a lot about those who are not currently succeeding in the retirement savings system that we have today. And that's really why you are the two leaders I wanted to start the conversation with. So maybe we start with me saying a little bit less and you saying a little bit more. And Yi-Hsin, can we start with you to just introduce yourself? Can say a little bit about, I know you're relatively new to State Street Global Advisors. Congratulations on the role. A little bit about what you see as that leadership role in and the way that your work functions in the retirement system we have today.
Thank you, Ida. It's a real pleasure to be here. I represent State Street Global Advisors, and we're one of the largest global asset managers in the world, very much known for creating innovative investment exposures and tailored solutions. And it's this last part that's really relevant to the conversation today, because the U.S. retirement market is really one of our very important areas of focus. And we're an investment manager, so we provide building blocks as well as target date funds to a number of plans across the country. And it is this focus as a company on helping the world's investors and the people they serve that get us very motivated to deliver really good outcomes for participants and to be a part of the conversation, whether it be on the policy side or on the investment side, that motivates us every day.
Thanks so much. Ed, I've had the pleasure of having a few conversations with you on the Hill, and you've been an active voice in both the policy space and in the market innovation work at Empower. So, do you want to say a little bit about your own leadership role and the growing role of Empower?
Sure. Yeah, thank you, Ida. Thanks for hosting this. This is fabulous. Empower was formed really back in 2015 when we brought three legacy businesses together, Great West, Putnam, and then the acquisition of JP Morgan. And since that time, we've grown quite a bit in all market sectors, from the small market to the corporate market. We do business with 26 of the 50 states, so we're very involved in the government market as well. And our focus is obviously on making the system better, making the system stronger. And as you acknowledged earlier, while we have 110 million people in the system and over 9 trillion saved, it remains a work in progress. With 33 million small businesses in this country, many of whom are not offering a plan today. And I know we'll get into that conversation, but that's something we're very focused on as a company.
Yeah, I do want to paint the picture where it's a very America can get a lot done, but sometimes we create a lot of complexity in the process. And there's as both this and the next panel will go into, the foundational part of insurance in retirement is Social Security. The defined contribution system, which is what the 401k system works on, is really the fundamental workplace savings function that when you have access to that, you have a lot more opportunity to build that additional level of savings. And of course, people can leverage other kinds of personal savings and assets as well to think about their long-term, both generational wealth and their retirement security. But when we think about that worker savings, that adequacy, building up enough assets, and when I start to think about it, I think the future of wealth is income, right? Because at the end of the day, it's really about what is that level of routinely positive cash flow once you stop working that you're going to have access to. And that's really the big problem right now for so many Americans. We see, again, Ed, to your point, a lot of folks don't have access at the workplace. And others, while they have access, we've just published some work with partners that has shown highly disparate accumulation rates between African American saver women and others, based on just the lack of other kinds of financial services and opportunities in their lives. So this is already a growing sense that there's both a public role and a private sector role in both understanding and solving these problems. Both of you alluded to the states that have done a lot of innovation in this space. And the states have acted in many ways in the absence of federal policy. And so I'm wondering for both of you, what you see as the promising work of the public sector that you're engaging with as a private provider into the retirement savings system. And you want to go first, Ed, and then we'll go to you, Yixing?
Yeah, I'm happy to start. I mean, well, first and foremost, I think that this collaboration between the private sector and the public sector dates back to ERISA. And there's been a focus on improving retirement policy for decades in this country. In fact, it's one of the few areas that historically has gotten bipartisan support. I would say more recently, what we've seen with Secure Act and Secure 2.0 has been, I think, very constructive, particularly as it relates to some of the things that you outlined, Ida. And I also think that the formation of the state auto IRA programs have been equally constructive in terms of driving new plan formation, if you will. These mandates in these states have worked. They've spawned new 401k plans, which I think is positive. So I think there's lots of examples of the public sector and private sector working together, both on Secure, on Congressman Neal's legislation, on the work that Senator Cardin and Senator Portman worked on together in the Senate. So at least we have that going for us, right? And I think there's been really strong collaboration with the private sector, working with Congress, with regulators to try to advance public policy in a way that, you know, perhaps isn't as common in other areas. So I think we're going to see more of that going forward.
I would add to Ed's comments. I think, you know, if we take a step back, there actually has been tremendous progress with the PPA Secure 2.0 and addressing both access and the coverage gap. So, you know, we all know the development of QDIAs and target date funds as a default, enabling savers to basically be fully invested over their lifetime, the creation of multi-employer plans, tax incentives for small businesses to set up plans and make employer contributions. And as both of you have noted, you know, it is pretty substantial and innovative, I think, that we've seen close to 20 states implement these state-sponsored retirement programs to really fill that gap. And ensuring that employers, you know, that have over a certain size are auto-enrolling their workers. Yet at the same time, you know, the underlying concern is that even though access is opening up and we've seen great developments, we still have a lot more work to do. And I think fundamentally it's a question of, can the market really fulfill and address those 57 million Americans that don't have access to a workplace retirement plan? Or is there more work needed in terms of a federal answer for this, as much as we're really delighted to see the states step up?
Yeah. Yeah, I want to go where you alluded to just there, Yishin, with some of what parts that the market can do, because obviously there will need to be more. You know, I think you all have all seen in your work that when there is more than just a suggestion that employers enroll, it's not that many employers don't want to offer this benefit, but it can be very costly if you're a smaller business. One of the things that's changed a lot about the private provision of savings plans has been the way that technology is being leveraged and the ways that you're investing in it, and thinking about the ways that it can create economies of scale. So there's been another place, I think, where, you know, there's the suggestion in the policy environment of being able to, you know, pool across small employers. But could you talk a little bit about some of the market innovations that are the other side of this, that are potentially helping to make it more cost effective and more successful, both to provide plans and also to accumulate assets at the level that are needed for households to think about financial security? Any part of that. And Ed, I'll say one, I was listening to another podcast with you, and I think you were able to quantify just the growing percentage of the technology spend that's the base of your company. So it really is a major investment to think about what it changes about what you're offering and how you can offer.
Yeah, I think a lot of the impediments to small plan adoption have been removed. You know, we just referenced the tax incentive that's been made available to small businesses to offset the cost associated with setting up a plan. I think that's material. Obviously, that was done in large part by Congress. Secondly, the fiduciary safe harbor that's been granted to sponsors, I think eliminates or at least reduces the likelihood of small business owners being sued or being held liable in setting up a plan and putting a plan in place. And then third, I think a lot of the complexity associated with it has been streamlined. Some of that's regulatory policy changes. Some of it is just what providers like us and others have done to make it simpler. And, you know, I think the state auto IRA plans, the multiple employer plans, the pooled plans, the PEO space even now has really started to get a lot of traction. I think all of that has made it more economical for small businesses to offer plans. And in addition to that, there's work that we're doing and other companies are doing in that micro plan market where honestly, we were challenged to be able to participate in that market before because of the cost associated with providing plans at that level, but also the distribution challenges. I mean, how do you actually get those plans in place and installed? There's millions of small businesses today that don't have access and don't have plans. But we've made some positive steps, I think, to address that. We have a solution in the market today that's getting a lot of traction. And, you know, we think there's going to be a proliferation of small plan formation here over the next several years. And that's a market that we think we can participate effectively in. So there is a lot of innovation, Ida. It's happening. There's a lot of small venture-backed companies in the space now that I think are doing very positive work as well. So I'm encouraged. But you know, it remains a work in progress, like we talked about. The one thing I just wanted to mention, though, we have so many of the tools at our disposal. I mean, if you look at the data that we see, for example, you know, people that are automatically enrolled in our plans, after 3 years, 92% of them are still saving. If they're automatically enrolled and they have access to auto escalation. And conversely, if it's a voluntary contribution, only 29% are saving after 3 years. So we've got 62 to 64% of the plans in this country that have adopted the auto features. Should be 100. And so there's work to do in plan and getting people to save more. And your question obviously centered more around those that aren't covered. But I think, you know, we need solutions in both areas, right? We need people that have access to save more. And when auto escalation is a feature that's embedded in the plan, less than 5% opt out, right? It's the power of inertia. And so we ought to be leveraging a lot of the tools that we have at our disposal.
Seems some great questions in here, but we are just the kickoff act. I'd love to think about some ways that we can delve into some of those questions together. As part of what you just said, Ed, makes me, and this is really something we talked about a little bit in our earlier prep and thinking about this call, that there's actually a lot of reasons to be hopeful. That this is a very solvable problem in many of its dimensions. Look, we're not saying it's not a hard conversation, but it's solvable. So Ishan, I would love to kind of ask you to close us out in this in terms of thinking about, you could certainly mention the technology pieces, but for time's sake too, just thinking about what makes you hopeful, but I would say pragmatically hopeful, not, you know, it's not a throwaway conversation. I was thinking, you know, if this is a solvable problem, what makes you hopeful that leaders today are going to prioritize and solve for this?
Need to build on Ed's comments. I mean, there is bipartisan support. There's an enormous focus on this issue because we have 10,000 baby boomers retiring every day. And so that attention in Congress, I think, is very valuable. You know, we didn't touch upon sort of the, you know, the lower end of the market, but I do think this is where we got to think about more of a federal mandate. Auto enrollment, auto escalation, because we know that small businesses are disproportionately impacted. We know businesses run by women and people of color. We see a lot of disparity in terms of access and participation. And this is at the same time that I'm encouraged by the level of innovation that we've seen across our industry. I alluded to the development of all the target date funds and the glide path. We've seen enormous movement into index and lower cost options that's benefited companies like ours. And then very importantly, we've been focused on delivering retirement guaranteed income type solutions that are really built into these plans, which again, as Americans, we're living longer and longer, and that's the good news. But ensuring that income is there, I think, is also reason to be very hopeful, because the participants across the board are really trying to think through, how do we address the issues Americans that are trying to save for retirement, can be addressed and addressed well.
Yeah. Well, we're going to be holding our 8th annual Aspen Leadership Forum on Retirement Savings with people from your companies, from 60 other individuals who really have also committed both leadership and time and focus on thinking holistically about how we solve this problem across public and private sectors and across the financial challenges that people are facing as they try to prioritize some of the long-term focus along with some of the short-term issues that keep cropping up for folks. So it's going to have to be a down payment on a longer conversation, but I want to thank you both, Ed Murphy from Empower, Yixing Hung from State Street Global Advisors. Thanks for joining us, and I will give you back the rest of your hour. Please feel free to watch offline. If you all turn off your cameras, I'll invite Karen Andres, who is Aspen FSP's Director of Impact Strategy, to come on. Hi, Karen. Thank you so much.
Hello. Thanks so much, Ida, and thanks so much to Ed and Yixin for joining us. See you later, Ida. I'll go ahead and transition to the second phase of our conversation with another set of leaders. And I'll invite them to turn on their cameras and their microphones as I, at a high level, share who's joining me. So we have Yemi Rose, the CEO of Color, Catherine Edwards, an economist and policy consultant, recently heard on a very cool Weeds podcast called Let's Fix Retirement Together. So she's here for obvious reasons. And the inimitable Lee Phillips, the CEO of Save Our Life. Thanks so much for joining me, friends. And before we pick up on the final threads of the conversation with Ed and Yixin, I want to note that I think what is interesting and cool about this conversation is that I wouldn't say that any one of you is like squarely in the retirement savings world, and yet here we are having a conversation about what to do about that system. So I think what I'd love to do is hear from each of you, like, you tell us who you are and what is your stake in the issue of retirement security? Like, what's driving this? And we'll start with Yemi.
Hi, Karen. Thanks for having me. What's our stake? Okay. We at Of Color, we're a mission-driven organization. Our goal is specifically to improve the financial lives of workers of color. And all that we are speaking about today in terms of retirement space kind of exists in a country where we know that Black Americans specifically hold only about 15 cents for every dollar held by white Americans. So that's the general context that this conversation is taking place in. And when you think about wealth, the majority of wealth is held by Americans in their home and in their retirement accounts. So with homes, again, being specific to Black Americans, the Black home ownership rate in the late 60s was like about 38%. It's 45% today. So we also missed out on the appreciation of homes that during and following the pandemic. With retirement, I think over 70% of workers of color work in frontline jobs with few prospects to earn enough to comfortably take advantage of an employer match if they're even offered one, right? And this is before you even take into account the leakage through hardship withdrawals. You know, we see something like 2/3 of hardship withdrawals coming from workers of color. This is before cashing out their savings during a job transition. Like more than 50% of Black and Hispanic workers do this. So this destroys the compound interest opportunity. So for us, it's extremely important that we participate in and help to inform the conversation. The system that exists right now was not built for us, and we want to ensure that any modifications takes the millions of underserved workers of color into account.
Well said. Thanks, Yemi. Let's go to Lee. Lee, tell us a bit about you and Save Our Life and your stake in the issue of retirement savings.
Well, thank you, Karen, and thank you for having me. It's great to be on with Yemi and Catherine and everybody. So Save Our Life is a nonprofit advocacy organization, and we focus on the financial health of Americans with low incomes. So we have a financial technology platform that reaches tens of thousands, hundreds of thousands now, people across the United States. And we're really focused on how can we help individual people to improve their financial health today, but how do we also then focus on the systemic change that is necessary to make sure that people have the opportunities to make advancements towards financial health. And within that, of course, we're looking at a financial system that is largely not designed with purpose to meet the needs of people with low to moderate incomes. And, you know, it's kind of interesting thinking about through the lens of SaverLife that started out as a IDA provider, as an asset building organization known as EARN. And then, you know, 10 or so years ago, made a big pivot towards tech and towards scale, which is great, but also towards focusing on liquidity. So, you know, this issue of how do you help people really have the resources they need to meet their day-to-day expenses and stay on track towards longer-term goals. And now I think, you know, we went from assets to more emergency savings, liquidity, and now I think we need to kind of find ourselves in more of a middle ground, right? And so how does understanding financial stability and helping people achieve that actually set them on a wealth building trajectory? And I think that's kind of the heart of the conversation and a lot of the things we'll be diving into today.
Great. Thank you. We'll come back to a lot of these themes. I'm hearing liquidity, other parts of people's financial lives. You can't solve retirement savings without solving some of these other things. And that brings us to Katherine. Katherine, tell us a little bit of who you are and what's your stake in this issue.
Well, howdy y'all. I am an economist and I'm a labor economist. I mainly study workers, their earnings, their participation, and their program participation when they're not working. I have no stake in retirement. As long as we don't go around the room and talk about how much we've all saved personally, I don't want to bring that up either, because I was in grad school through a lot of those earnings years, but in terms of stakes in retirement. But, you know, I came to the notion and kind of study of retirement security and policy around it via Social Security. And I was something of a policy expert on Social Security when I realized one of its biggest challenges is just how much worse all other aspects of retirement savings and security are faring. So Social Security has its problems, but certainly one of them is just how much of a load it has to carry because everything else is also underperforming. And, you know, Social Security is basically like the retirement income of last resort. In a lot of ways, it should be the last dollar you spend and not the first dollar you spend. But those first dollars for many Americans weren't there at all. And so it very much was a, if you give a mouse a cookie type of, you know, well, now we need to save more. Well, now we need better plans. Well, now we need like all these other financial burdens on people's lives to be easier if they're going to save it all.
So I want to sort of start with, you know, Ida mentioned at the top that there's retirement savings is in the water right now, or the ether. And there was a really provocatively titled, long form piece in last week's New York Times Magazine titled, "Was the 401k a mistake?" Right? And I know, I'm sure we all gobbled that up. What say you? Where, you know, another way of saying we've got this system, it works pretty to really well for millions of people and not at all well for millions more. And so what do we make of that? What do we make of that? Yami, you're looking like I see you giving you side eye, and so I'm going to start with you.
Yeah, that was like, don't call me first. Let's see.
You're welcome.
First of all, the article itself was really sobering. At the same time, I'm really, really happy to see some of these issues kind of laid out in an easily digestible way with very real anecdotes. But was the 401k a mistake? I mean, I personally think that asking workers of color who lack the resilience when it comes to wealth and who have consistently kind of been hosed by the financial services system and have consequently low levels of institutional trust, I think that asking us to guide our own retirement savings was a mistake. And, you know, and even with target date funds, right, which have been around for close to 30 years, maybe, you know, they've not been anticipated to solve, even though it reduced complexity. And I think the reason why is that, you know, folks of color are not the average, right? And working off the averages don't work for us. There's a lot of complexity in determining, for example, the glide path for workers of color, right? Allocations need to take into account not just the market's historical return, profiling age, but how vulnerable you are to business cycles, right? And our jobs are very vulnerable to business cycles. So I think when you add in lower contribution rates, the typical glide path for worker of color is going to be way too conservative after we hit 45 or 50. So, you know, I can't remember the name of the lady that was featured where they, as the anecdote in the article where they talked about her financial life, but I was looking at that and thinking, wow, this is, even though this is being presented as something that is not great, there's so many workers of color who would gobble that up. Like if you gave us $200,000 in retirement savings, that would just be a huge, huge boon for us. So sobering, but I'm happy that we're talking about this out loud. So that's my take.
I I just thought the headline in some ways was a little bit not dishonest, but maybe misrepresentative, because it makes it sound like 401ks were planned at all. You know, and to borrow Lee's phrase, I mean, they were not designed with purpose. It's not as if the federal government sat down and was like, all right, we are going to put a massive amount of tax revenue towards subsidizing elective retirement accounts offered by employers. They never made that decision. In some ways, they made other decisions that kind of spiraled into that because it was not necessarily like a top-down intentional path. And you know, and since then, it's just been, you know, one fight after another to make this to the benefit of workers and not to the financial gains of the financial services industry. Like, I am so happy that we are here and talking about, you know, how to make retirement better, instead of all of us talking about what are we going to do about expense ratios on funds and how do we explain to workers that they, you know, their account is kind of being emptied on the back end, but they don't realize it. So I mean, I think, so with that kind of caveat of mistake implies design, I would say what we have learned from the 401k is how to accumulate wealth. As Ida said, you need to be passively invested into a low cost fund for a long period of time. What we have also learned is that the private sector, private employers in the financial services sector have had 40 years of runway to prove that they will never give this to the bottom half of Americans. Like, it's not, we can't really expect it to change. Even the share of workers who have access to a 401k has not moved as much over time. It is a pretty kind of fixed set of employees. So if we actually want all Americans to have access to retirement savings, you know, this will not be, it will not come from this. So it makes you wonder why they get the subsidy and other people don't.
You know, I can jump in on that, Katherine. And I did joke with Katherine. I was going to say, I agree with Katherine at least 50 times today. So there's one. So, you know, anytime where you start with any product or service, right, that's not being designed for an end user or is not being, you know, segmented well for a market, you're not going to get something that works very well. So if we're looking at something that's like half of the people have it, for Save Life members, that's a lot. It's a lot less than that, right? 30% of our members say that they have access to an account and that they're saving for retirement. So that's an issue. And not unlike most of the financial system, it's very much designed for people, I'd say people like me, right? Like, I have one job. I earn the same amount of money in my paycheck every 2 weeks. My employer provides me with a way to save for retirement and also applies, you know, a matching fund. So the typical Save Life member does not have one job, right? Has multiple jobs and is also receiving their income from self-employment, gig work, you know, W-2 employment, and also public benefits and other things, and a huge chunk of money once a year in the form of a tax refund. So that's the picture for most of our members at Save Life, and yet this system is kind of designed for not that, right? It's designed for consistency and all these other factors that go into play. Also, I think that we silo things a lot in the financial health sector, right? This is a retirement issue, and you know, this is a mortgage issue, and this is something else. That's not how people live. And you know, for most members of Save Life, it's not that people don't know they're supposed to save for retirement, it's that they cannot afford to. And so if you're going to kind of look at this from a balance sheet perspective, it has to look at the whole picture, right? Not just this one sliver of it. And you know, I'm hoping I'll tee Katherine up to share some of the great insights that she shared on this already. But you know, I know it's a little bit frustrating to say, well, the answer is, you know, you have to increase people's wages and have a better, you know, healthcare system and childcare affordability and all these other things. But that's also the reality. So I think, was it a mistake? And yeah, I mean, for me, no, but for millions of other people, absolutely. Well, not a mistake. It's not working. Let's say it that way.
But you know, Lee, it's so hard because there's this almost like bewitching contradictory notion of treating people equally and then not treating people equally. But the problem with the current system is that it the 401k is of benefits to people who have access to it. And so the top half gets a 401k and the bottom half gets told that they need more financial literacy training. Right. So they'll learn how to save, even though the top half, we know that these people, like, everyone makes terrible financial decisions. It's not like being rich inculcates you from being an idiot with money. You just get to make more mistakes than other people. You have more of a landing pad when you do. But, we talk so much about financial literacy when we know auto enrollment works, but auto enrollment isn't offered to everybody. So you almost want a system that treats workers and individuals equally. But at the same time, Lee, I think the bewitching part is that you also want a system that knows that workers are really, really unequal, that people have one job versus 5 jobs, that they're self-employed, that they do this over different periods of time. And so I always wonder how to characterize this system of, you want everyone to get access to the good thing, but you also want policy to reflect just the varied financial situations of people as they come in to save, and not just kind of characterize it as like, oh, they're not financially literate, they're not savings enough, we should probably educate them.
So this is a really good teeing off point. I want to, please believe me, we'll come back to okay, so what would you do at scale to make this system work, right? You're not getting off the hook on that question. Ed and Yishin didn't, and you aren't either. But I want to detour for a second into the land of, wait a minute, even when we do design plans with automatic enrollment, auto escalation, automatic investment options like target date funds, as it turns out, in fact, those plans still aren't working the same for everybody. And permit me just a moment, and Yemi, I know I'm coming to you next. So several years ago, we launched a partnership with Morningstar and DCIA to investigate whether or not this was true, right? To say, if it seems like most plans in America, but not all, to Ed's point, are heading toward a full automation design, does that cure things? If you have 2 workers who earn the same amount of money, do they therefore end up with the same balance? And several of us had the instinct that maybe they weren't. And in fact, that's what the data is bearing out. When you marry demographic information like race and gender with 401k transactional data, you end up with different balances over time. So this collaborative for equitable retirement savings has pushed out analysis in this past several months showing the receipts on this. This is, and to Yemi's point, a lot of it is about hardship withdrawals or pre-retirement withdrawals that are driving these disparate outcomes, even when you control for income, and also modeling the impact of the savers match, which is a part of the Secure 2.0 Act. And so I would just say, Yemi, I think my question to you is, it looks like we are starting to acknowledge as I'll just say ecosystem, that this is true, right? That in fact, other parts of people's financial lives are significant drivers of outcomes in the retirement savings system. And I guess the question is, how much good do you think we can do with this? How much will this matter? What's the most we could achieve by plan design or benefits changes or other tricks and widgets to be able to ensure that the Black woman and the white man who were paid the same end up in the same plan, end up with the same balance? What can we do?
Yeah, so first of all, you're 100% right in terms of plan sponsors. The HR suite has typically ignored race outside of employment quotas, and kind of missed the disparate outcomes that are rooted in race. We've been saying for some time that plan sponsors should bill for Black women, and you'll see a positive ripple effect. What does that even mean? It really means culturally relevant communication. I say this all the time, like almost every Black person in the United States leads with their Blackness, and that's the first thing that people see when they see you, and that's beautiful and challenging. The challenges, though, lead to an affinity towards those that kind of understand your struggle, especially because, historically we have well-earned low levels of institutional trust. And so communications, I think, that utilizes messaging and messengers that understand the struggle will be most effective. My background, for example, is not in finance, but in comms, and it's helped a great deal in terms of crafting messages. But I think there are long-term fixes that I personally believe we're in a collision course with, putting mandates in that bucket. I think we're in crisis right now, though, and so we need short-term solutions that will also stem the bleeding. I think the progress with emergency savings and Secure 2.0, that's very promising. I think all employers should take a look at who is taking the bulk of their hardship withdrawals and ask themselves if more of their employees truly have an equal shot at a dignified retirement. Happy to see that more and more record keepers are starting to ask about race. But in the short term, and some of this has been mentioned before, I think all employers obviously should offer a plan that auto enrolls and auto escalates. I think we should track the number of Black and Hispanic employees that participate and take steps to encourage participation. And of course, financial education opportunities that help them to kind of meet the needs. So, I think even if we do all of this, I think we're still going to have to rely heavily on Social Security because of some of the factors that we've talked about, right? The wealth gap is real, and it's hard to swim against that tide. And it's really because a lot of us just don't have the cash to participate. It's not an issue of, access is an issue, but a lot of times even folks that have access, they may be the first in their family to get a good job with benefits, likely took on more student loans. And I could go on, but I don't know if I don't know how many hours we have.
No, I know that this is your bread and butter, right? And full disclosure, you have joined us as an advisor on our project. And so I know I always benefit from your, I think, optimism that we can do good, but also clear-eyed sense that this is, in some ways, the retirement savings system sort of is it tells you, it's sort of the sum total of a financial life, right?
And look, some of the CFRS data, this is new data and it is very helpful, but there have been studies that have shown us for decades these disparate outcomes. There have been calls across the board for changes that take into account our financial lives. So, I'm hopeful, but I'm also realistic. And, there needs to be some real action, both in the private sector side and the public sector side.
Yeah, I want to come back to what that action needs to look like. Katherine, you, on the topic of other parts of people's financial lives that you have to design for if you want to get retirement savings right, I know you have some thoughts in this regard, and Lee, I'm coming to you next. You have any thoughts, Katherine?
I always tell people retirement is the report card, right? You can make high income in a year, you can make a low income in a year, you can save a lot in one year or not in the next, but you cannot escape kind of your overall performance in the economy, and how well the economy treated you is going to be reflected in your retirement security, because aging is the report card. And, you can't kind of fix it at the end. You have to make the investments throughout people's lives. So, the jobs that they have, the wages they earn. So no, the draws on people's ability to save and what kind of pushes out retirement savings and how retirement savings are leaked. They're myriad. There are some pretty high ticket items that you could think of that, in terms of things that people have to spend a lot of money on, but also would be within the public sphere of that spending as a result of policy failure or inaction, or as opposed to that's just the way that the world works. The top of mind for me is childcare. So I think it's pretty reasonable that parents who put their kids in childcare will spend somewhere between $50,000 to $100,000 per kid. And if you say that wouldn't affect retirement security, that would just be crazy. And if they decide not to do it and stay at home, then they've lost earnings, and it'll have a really hard time coming back to work if they do come back after their children kind of enter school age. And if they do, it would be highly unlikely they would earn the same amount of money. So that becomes a very clear policy problem with a clear solution that is really about investing in the start of life for children that has a lot of spillovers for parents' ability to work and save that should have a spillover in retirement. I think there are those types of policies, in childcare to me is the largest, just because the ticket cost is so high. But then there are some areas where I don't know what the obvious policy solution is, but it is a problem. So, I'm sure Yemi would point out that the Black-white earnings gap is not only not falling, in some ways it is getting worse. Because when we adjust for education and experience, the gap is larger than it should be instead of smaller. So that means that if I'm a Black student and I go to college, I can expect that that investment will have a lower return for the rest of my life just because I'm Black, right? Not because of anything else, but just the Black effect of being a college graduate is going to be 20% less earnings, maybe every year for the rest of my life. How does a retirement system take that into account in a way that's fair? And the same with women, women and men, have pretty similar earnings adjusted for, say, their education and years of work until the woman has a kid. And as soon as a woman has a kid, it is a 20 to 30% reduction in her lifetime income. So something about these.
Happy Mother's Day, by the way.
Happy Mother's Day. to all who celebrate. So something about these cleavages are not easy solutions, but this is what I mean by the report card of you can't earn 20% less of your lifetime when you have a kid and have the same retirement security when you show up. And so these inequities in the economy where we have not seen a lot of aggressive policy or any policy, that's where we need to start making inroads. And I've told people that any act from Congress to adjust Social Security shortfall that does not have a companion legislation to deal with labor force participation, to deal with, the ability of disabled workers to get back into the workplace, it's only ever going to be a half measure.
Mm-hmm. Lee, I'm wondering, does this resonate with you? You're in some ways the people that you serve are the people who are probably least served by our retirement savings system and who most need a system that is designed specifically to work for them, right? And I'm just wondering on this question of what are the biggest needs outside of, what else in their financial life? What are the biggest barriers in their financial life that is keeping them from being able to participate, even if they did have access, right? Because obviously most of them probably do not.
Yeah, so Save Our Life members, just to say a little bit about them, are mostly women, mostly women of color, and we have members across all 50 states, and average incomes around $30,000 a year. So very much kind of the population that we're talking about. And then to Katherine's point, the majority of our members are mothers. And so again, you kind of see all of the issues that we're raising kind of reflected in the fact that only 30% of them have any savings for retirement. And so, or have access to retirement of any kind. And so, if we ask our members, I mean, it's not anything that would be surprising, but insufficient and inconsistent income is the number one driver of people, the number one barrier to people's financial stability. And I think insufficient income is one piece of it, but inconsistent income is the other, right? Because that's what drives these volatility in income, really drives these debt cycles that people find themselves in, where they can't make ends meet because there's this just constant discrepancy between income and expenses. So that's a big part of it. And then high cost of living, of course, are next on the list, and high rates of unsecured consumer debt. So that really just kind of fuels these issues. And so when we're thinking about solutions, there's a lot of good stuff in the system that we're talking about. There's tremendous advantages in Secure 2.0. I think we do need to do a better job of market segmentation and to be real about the fact that we can't declare victory here, right? I think we're all in agreement, right? There's still millions of people who are not going to be able to participate, which means that inequality will probably worsen, right? Because those who are able to participate are going to accelerate, and those unable to participate will get left further behind. And I'm kind of thinking some of these design questions around hardship withdrawals, and I've got myself in a bit of trouble sometimes from maybe saying that maybe we shouldn't refer to these things as emergencies, because from our members, these aren't unusual events. It's not unusual that you had fewer hours at work and therefore you're short on your rent. That is a pretty regular kind of occurrence for people. So really thinking about portability of retirement savings, allowing people to save more when they can. I think Yemi or Katherine have both spoken to this, like people have ups and downs, right? There may be periods of time when you're able to accelerate and save more, tax refunds, all these kind of moments where maybe there's an opportunity to save more. And then there's going to be moments in time when that's not possible. or moments in time where you're going to actually need those funds. And I can tell you that if someone is facing down, something catastrophic like an eviction or a medical issue, it doesn't matter what the fees and penalties are going to be, that it will not deter you. And so then you're just further erode people's wealth, right? You further strip from people by taking the limited assets that they have and charging, fees and penalties on top of that when they need those funds to do something that is meaningful and important in their lives.
Mm-hmm. So what do we do with all of this, right? So I'm thinking about where Ed and Yishin landed, where Yishin in particular at the end said, look, like states have made a lot of progress. It's tremendous in terms of widening access and, a federal mandate. And to clarify, right, a requirement that every employer in America auto-enroll their employees into some version of a retirement plan, right, that meets a set of standards so that everybody can participate, right? If that's, and there have been proposals and bills to that end. There are other versions of solutions, right? That other proposals, other proposed legislation that would seek to solve the access gap and allow for millions more people to participate in what is effectively workplace investing, right? Workplace wealth building. The system does a lot of things, right? Or is purported to do a lot of things. The thing that has turned out to do really well is build wealth for those who are able to contribute, right? So we're trying to expand access. But with everything that we're talking about, right? The portability challenges inherent in our system, the realities of people's financial lives, what's a nation to do? What's a nation to do with this system that we've built, this incredibly powerful wealth generator that works for some but not for everybody? What would you do? What's your big fix? What are you most focused on? Who wants to go first? Katherine, you're nominated.
I would say that, the first solution is to have the government drive and not employers. And I don't say that to undermine the efforts and actions and incredible victories that legislators or employers have accomplished, but not every worker is powerful. Not every worker is respected. And I'm not saying anything about the people who participate here, but I mean, there are some employers who will never say something nice about the people who work for them and would not extend a retirement account to them. And if they did it, we really don't have a sense they would do it well. So child labor is up 250% this year or over the past 5 years, and it is continuing to rise. And we have billions of dollars stolen every year out of wages from wage and hour violations of telling people you need to clock out and finish sweeping, or I'm not going to pay you to put on your uniform, even though I'm supposed to. I don't bring that up to say, this is what employers are like, but to tell you this is the reality of what putting the onus on employers to benefit their employees is. We struggle to get employers, certain types of employers to pay workers what they are legally owed. We struggle to get employers to not employ children in hazardous occupations. And so do you want to put such an the important part of wealth building in the hands of every employer? And I think the answer is not if you care about people at the bottom, not if you care about Black people, not if you care about women who don't have husbands or women who have gotten divorced and gave away half of their retirement asset just to make sure they could keep custody of their children. So I think for me, having it not contingent on the employer, not contingent on what your job is, but having the government drive is the only way to get to a fair solution. And I kind of feel the same way about states and the federal government of, I love that states are setting up savings accounts, but I also want Black people in the South to have access to saving. And they won't if it just goes through states. And these are really kind of hard, ugly things to think about. But when we don't think about them, we can't fix them.
That's a fundamental tension. That's right. Yemi, you came off mute. Thank you.
Yeah. So I also think that this is going to be something outside of the retirement system. I think the context within the retirement system is that the retirement system exists and is very important. So, there are folks way smarter than I am that have proposed, Derek Hamilton, things like baby bonds, things like postal banking. I think if we make a conscious decision to start with the persona that's most in need, right? Again, Black women, I think it'll have a ripple effect that influences the system in a really positive way. There's a lot of this data is really discouraging, but I stay positive mostly because there's a lot of partisan infighting, but whenever you speak to the staffers, right, I get a chance to speak to the staffers, I get a huge lift in faith. So, I think there's a ways to go, but I think there is generally the will to do it. It's a bipartisan will. I think ultimately, the timing is really important, but we're going to get to a point where we don't have a choice, because I think an economy that is top heavy with wealth is just not good for the country. And, we're going to realize that maybe the hard way.
Lee, thoughts on that question? What's a nation to do?
Yeah, seriously. I mean, I think, I guess I agree with Katherine again and Yemi, but we've been shifting risk towards workers and individuals for a long time. And whether or not we're talking about healthcare, childcare, paying for education, all of these things, and are there great employers out there? Absolutely, and great states and people who are going to do all these things. But to Katherine's point, it's not a guarantee, and it does mean that the most vulnerable people will be left behind. But at the same time, I think we need to again think about market segmentation, think about what are the wins in Secure 2.0 and how can we really roll that out? So first off, we can start how can we implement what we have as well as we can, right? And so this is an opportunity to really think about, okay, there are resources out there now, and those resources are going to help people. They're not going to help everybody. It's not going to solve everything. But first off, how can we really make sure that we get the plumbing right in a way that allows people to draw down the savers match and to benefit from auto enrollment and all these other things, and to take as much friction and complexity away from that system as possible, but also design it in ways that, again, as we keep saying, that are designed for people's lives and purposefully designed to increase people's wealth and financial security and not to deplete it. So I'll start with that, and then we have to also turn our attention to the what about everybody else. And I think the programs like House Savers are really, it's great, it's inspiring, it's allowing small businesses and others to offer this benefit to their employees, right? And I think that also is really important. One idea, someone put in my head earlier today, actually, when I was asking for thoughts on this topic: why do we have so many different tax advantaged accounts? We have one. And so to Yemi's point about baby bonds and things like that, this lifelong asset savings approach, right? So I don't have to have a 401k and a 529 and a health savings program and a alphabet soup of things that perhaps the federal government does create an account for everybody, which we could contribute as individuals, as well as other interested folks. And Karen's smiling, so maybe
I'm only laughing, Lee, because we literally next week we'll be talking. We have a whole session just about the lack of interoperability on tax treatment of these kinds of accounts, because one way that you could give a special advantage to folks who have been excluded from the system is to start retirement savings at birth. But right now, there's not an obvious vehicle for that would allow for the kind of flexibility and liquidity that we all have talked about on this call. People really need. That's just the reality of people's financial lives. So I'm just, of course, I'm not surprised to hear you keying right in on that. And Katherine, I'll give you the last word before I close this out.
I was scrolling through the chat because we didn't take a ton of questions. But because the conversation was so good, but I saw that someone asked about raising the retirement age. And whenever people bring that up about oh, well, maybe we should raise the retirement age, I feel like I'm there is so much you could do before 65 rather than making 66-year-olds solve this lifelong economic challenge and be well, sorry, we didn't fix it by 66. So now you got to work till 70. It really does. You do get the sense of well, this is just, here's some Band-Aid right at the end. And, now we're going to put it on the backs of 66-year-olds because we didn't do the right thing when they were 30. But then there was also, a question about, we have been talking a lot about Black workers and Black, savings and Black wealth disparities, but Hispanic workers, and Hispanic savings disparities, it has its whole other set of challenges. And I think that this kind of speaks to one of the key problems of the system is that it has done very well for a particular set of workers, which is white professional class, or people in the professional class that just happens to be predominantly white and more male, and anyone outside of it, does not do as well. And that is a system not working. And so I will go back to when the federal government drives, it's a lot harder for them. It's not to say they can't, but it is a lot harder for them to single out people and leave them behind. Whereas a private sector patchwork system, can do it, rather efficiently, even if they don't intend to.
Well, I think Katherine, you're keying in on this is just one of the. This is all about embracing tensions, right? So our goal here is to surface the tensions that we have to grapple with as we seek to make a system that works for everybody, and especially to your point, one that is built on a public-private partnership, right? That's what Ed Murphy said at the top, and I think we can all see the pros and cons of that kind of system, the innovation, the competition, and also the gaps. And so I want to wrap us up by saying that there are many more additional tensions to explore here. But I am so grateful to all of our panelists for joining us today, and looking forward to many of the conversations to come in the next few weeks as we invite more people into the dialogue. So thank you so much to Katherine, to Yemi, to Lee for joining us. And we're looking forward to the next installment in our Future of Wealth series. Thank you so much.
For having us. Take care.